joining us for this, our first Shares Investor webinar. I hope you find the introductory presentation helpful, and we look forward to answer your questions at the end of the presentation. I'm Gary Marsh, Group CEO, and presenting alongside me this evening is Peter James, Group CFO. The group benefits from a stable and experienced executive team. Over the last 8 years, we've worked hard as part of our strategy to build a strong senior leadership team, both at group and divisional level, and we'll cover this in a little more detail in later slides. So who we are. But simply, State provides electronics technology for demanding applications. The group is split into 2 operating divisions, systems and components, as you can see on this slide. Suffice it to say the 2 divisions are highly complementary. Our structure is such that we have good resilience and diversity without losing the focus on our core competencies. Our core competencies being solving customers' problems in a way that allows them to innovate. This often requires solutions for specialist or demanding applications where the group has extensive know-how and experience. Our heritage provides solid foundations. We deliver value through expertise and innovation. Critical to everything we do is our workforce. We benefit from having a very stable, highly skilled and loyal resource. A great deal of time, money and effort is spent ensuring that we hire the best talent, trying to motivate the teams to be the best, and ensuring that our leadership team have the flexibility to operate at the highest levels. With over 400 employees now in 14 locations across multiple countries, our focus on employee wellbeing continues to develop, with enhancing benefits and support packages being put in place. Our mission is to build an agile business with ever-increasing scale and resilience with shared benefits of all of our stakeholders. Our primary measure of scale being earnings per share. We'll talk a little bit about the group history here. State began life 53 years ago as a broker of electronic components. As the market matured, we signed franchise with semiconductor manufacturers and were company 150 to float on AIM 28 years ago. We grew steadily until the late 1990s when the dot-com bubble burst, and we began to see businesses going offshore, firstly to Eastern Europe and then to China. It was then a case of do we delist or diversify? Pleasingly, we chose the latter. The acquisition of Steatite 22 years ago was the genesis of the computing and battery business we have today within our systems division. Since then, we've made 12 further acquisitions, broadening the product portfolio, including antennas in our systems business in 2013 and vision systems in 2021. In components, we've broadened our product offering, introducing, for example, opto-electronics in 2018 and electro-mechanical components in 2021. Throughout our time on AIM, we've been consistently cash generative and returned profits to our shareholders. Conscious of shareholder dilution, we funded the majority of these deals through our own cash generation and bank debt. To date, we've carried out 2 fundraisers. In 2013 at £2.42, and nearly 2 years ago, raised just under £30 million at £10.25 in an oversubscribed fundraise for the custom power acquisition. And we'll come on to strategy and M&A activity on later slides. So our customers, we've got a long-term blue chip customer base supplying our technology into their demanding applications. Many of them operate globally, so a large part of our business is fueled by international demand. To give you an idea of the range of markets we serve, we supply industrial computers to the BBC, train ticketing machines to Atos. Renishaw is an example of an industrial component customer that came to us because of our value-added services. They're now both a component and systems client, with Philips Medical, 3M and Lockheed Martin utilising our battery packs in their products. The benefits of scale have started to pay real dividends, supplying more products to our tier 1 customers, so fueling organic growth. That said, we have significant potential for further growth here across all of our business units as we broaden our complementary product and technology portfolio. These slides explain quite clearly how we differentiate our service and serve our customers through our diverse product offering, specialist knowledge, and trusted relationships. The graphics demonstrate nicely how we're now able to have multiple touch points within major applications in key markets across both divisions in medical, rail, and UAVs as examples here. This gives us considerable advantage over competitors with less diverse product offerings, and indeed makes us more valuable to our customer base. So in unmanned aerial vehicles, so drone applications, as you can see in this example, the group is able to offer specialist capabilities of battery solutions, particularly suited to high altitude UAV applications, where at the same time bringing leading edge camera, vision and sensing technologies to our customers. Communications products, GPS and antenna solutions allow the group to enter the UAV market anywhere from the ground to the aircraft itself. I'll now hand you over to Peter, who will talk through some of the financials.
Thanks, Gary. So I guess first up, why invest in Solid State? Over the last 5 years, we've delivered some really robust performance in quite difficult times. So significant growth in revenues and profits by executing on our strategy. We've seen operating margins improve by more than 250 basis points to over 9%. And that's translated into in excess of 20% compound growth in fully diluted EPS. In terms of what we're looking to achieve, we're looking to maintain that growth in TSR, and we've set out our ambitions to 2030, and they are to become an international leader of sustainably engineered components and systems, continue to innovate, providing customers with our trusted technology for their demanding applications. And how are we going to deliver that? Continuing to develop and enhance our operating margins, and we aspire to replicate the progress we've seen over the last 5 years, and hopefully that will get us towards 12%. And most importantly, if we're able to achieve and continue the growth we've seen in both the top line and the margins, hopefully that will ensure we can maintain our total shareholder return growth close to 20%. In terms of some of the key financial highlights, the group's delivered pretty strong growth over the last 5 years that we're really very proud of in quite a turbulent period: Brexit, COVID, latterly Ukraine and Gaza. And the group's resilience has really been built on some of that market diversity that Gary talked to on the previous slides. So if we take COVID as an example, commercial aerospace when COVID hit really did fall off a cliff very, very quickly. However, medical, on the other hand, was particularly strong, where we supplied battery packs for powered respirators, and they took a year's worth of demand in 2 months. In terms of that resilient business model, it gives us a real platform that we can build upon. And yeah, we're very pleased to have announced in our recent trading update that 2024 has been a record year. We had a strong end to the year, and we were able to recognise some systems revenues on deliveries made in 24, which we previously expected to be made in 25. This pull forward had been driven by customer requirements to meet operational needs, and they needed the product as soon as it was available. And that enabled us to increase the consensus expectations for FY24. So those consensuses, the charts show you the actual results for 23, the consensus for 24 in terms of revenue in excess of 160 million, adjusted PBT circa 15 million, and operating margins continue to improve close to 10%. How does that translate? In terms of fully diluted EPS, consensus is expected to be circa £1, 100 pence, improving return on capital employed, and pleasingly net debt continuing to fall to just over 5 million of net debt, despite the strong close to the year and the associated investment in working capital. That strong balance sheet position puts us in a really good position to make a number of key strategic investments in the year ahead, and we'll come on to that in some of the later slides, but they're really important to underpin our 2030 midterm growth ambitions. In terms of the group strategy to deliver on that midterm ambition, there's really 4 key pillars Some of you may have heard our presentations in the past, but the most important pillar for us is our talent and our people, as Gary talked to. The development and investment in talent is evidenced by the investment in engineering talent, and we've done that through some quite innovative ways with the investment in eTech, which we've now brought into the group up in Newcastle. Broadening and complementary products and technology portfolio. Absolutely, that's the second core pillar. We've had some real success with some of our UK franchises and replicating those and extending the territories into which we can sell to include the USA. 3 of those this year has really helped us. Internationalizing the group. Here we've restructured our US components business, and that gives us a real focused sales channel, which we see as a really good growth market for us as we look forward. Developing our own brand product portfolio, that's really important because it drives improved margins. And here our Custom Power brand, you may have seen we've rebranded the group under a sort of common theme, and we've launched the Custom Power brand. We acquired Custom Power in the US, and we've launched that and rolled that back into the UK at the start of this financial year. And we've got some own brand leading edge battery packs as well that we're taking to market under that brand. We'll also continue to invest in our Duracool brand, which is high power contactors and relays for applications such as EV charging. And those products are really important growth drivers for part of our components division. In terms of M&A, our strategy is to continue as it has in the past, driving organic growth with complementary M&A. And when do we do M&A? M&A is a capital allocation decision between organic investment and strategic M&A, and that's driven on reducing risk. So we do M&A where it's a lower risk approach. And yeah, the 4 pillars of our strategy are absolutely key in us evaluating acquisitions and looking to make sure they're a good strategic fit as well. Of course, that doesn't mean we're not going to be opportunistic. Yeah, that we absolutely will look to take opportunities as we get bigger where, yeah, they're potential acquisitions where we can be more efficient, remove costs, increase market share, improve profit. Those things absolutely are things we've done well in the past and we will continue to do in the future, which will help us to achieve our goal of maintaining that shareholder return. In terms of the pipeline, there's some really exciting prospects. I think UK owned brand acquisitions are an opportunity for us. EU sales channel, US communications production capability. So replicating what we've got in terms of UK production capability in the US and looking to get traction in that market is another as well. So there's some exciting prospects both organically and in terms of M&A in the period ahead.
Thanks, Pete. I'll just touch on the key shares. I think that's obviously important to give you some history on that. The founders began to reduce their holding in 2011 at 90 pence, that being the founder of the company, Gordon Conban, and my parents. A fundraise in December 2013 at £2.42 bought in Hargreave Hale, which is now Canaccord. The Custom Power fundraise at £10.25 was strongly supported by existing investors, including BGF and Schroders, and broadened the share register. And we have new investors like Herald, JP Morgan and Charles Stanley joining the register, and others below that 3% threshold that we have to declare as part of our notifications include Aegon and Marty and Close Brothers. So turning to prospects and outlook, we continue to see strong pipeline and design demand across the target markets that gives us confidence in the midterm, albeit we remain cautious as we start FY 24-25 given the current macroeconomic and geopolitical environment. Going into this year, the group has a strong order book compared to historic norms of 50 to 60%, with the order book at circa 60% of our FY 24-25 current consensus billings. Furthermore, the shorter lead times across the group enabled more efficient conversion of new orders into billings. The group has secured exciting new midterm opportunities for multiple Tier 1 security and defence customers, anchored by a key customer. for which Solid State is investing in expanding its integrated systems production capabilities. In addition, the financial year will invest in developing the sales channel for our group's own brand Duracool antenna and optical products that Peter's already alluded to. The combination of these investments will be a cornerstone of driving mid-term operating margin enhancement and organic growth for the group. The board is pleased with the ongoing delivery of Solid State's growth strategy, where the business benefits from the diversity of markets adopting its technology, which continues to give the group resilience. Exciting progress and opportunities for mid-term strategic partnerships with our Tier 1 customers provides solid commercial foundations for the next phase of the group's organic investment and growth plans as the board looks to deliver on Solid State's 2030 strategy. Looking forward, the growth drivers for our technology and engineering expertise remain resilient across our target markets, and we're confident we can continue to deliver strong growth over the mid-term and longer-term strategy horizon to 2030 as we seek to maintain 20% compound annual growth in TSR. We're happy to take any questions. There is a research page on our current website on Solid State PLC. There's a new, brand new website coming online in a few weeks, and you'll find that there too. So there's some good information, some more detailed presentations and videos for you to look at your leisure.
Gentlemen, thank you very much indeed. Let's crack on straight away with the questions. First up, where do you manufacture your products?
Manufacture mainly in the UK and in the United States and California. We've got a number of sites across the UK.
Next question's about M&A. How does the company integrate acquisitions into the business and merge systems, policies, process, and employees? And I guess I'd have thought with that as well. How do you maintain culture? In that
culture is very important. We're very fussy. We look at lots of businesses and turn them away. We spend a lot of time in due diligence. We looked at 42 businesses in the United States before we settled on acquiring Custom Power. I have a very similar rigorous process in there, going through HR, quality control, safety and quality, very important to our customers. And we have been made sort of 13 acquisitions now. We're quite well versed on how we manage that process.
When you do an acquisition, do you keep the management teams of the?
It varies. Some of them we have kept, some of them retire. It depends on the structure of the business. The guy that runs our radios business started with us 10, 12 years ago, and he continues to run the division for us. And we see good throughput and career development of management through the company with the larger workforce we have now. So that's very pleasing to see.
Question about margins. You showed margin improvement, and analysts expected further margin improvement. How is that being achieved?
Shall I grab that one first, Gary? It's a numbers one.
Yeah.
So the margin improvement is twofold. It's by increasing the level of engineering value add. So really focusing on markets and customers that value the engineering expertise that we bring. And the second piece is operational gearing. We've absolutely benefited from the scale and the growth in the top line and the operational gearing that brings us. So it's a combination of two key factors. So gross margin clearly is driven by your engineering value add. Operating margin, which is really a critical metric for us, is supported as well by the operational gearing.
And next question, what is the percentage sales by industry that you supply, and do you anticipate to be key growth industries for future sales?
So I'll go, Gary, you might want to add a little colour. Industrial is a bit of a catch-all for us, but that's typically traditionally been about half of our business. We then have three sort of key sectors for us, which is security and defence, medical and transport. And medical and transport, it varies year to year, but circa 10, 12, sometimes 15. COVID year was strong for medical, but that sort of level. Security and defence has traditionally been 20-ish%. But in the current year, with the NATO contract that we announced in November 2022, that market is going to be a bigger proportion of the cake, as it were.
Next question, just to clarify something from one of the slides, did the return on capital employed decrease in 2020 to 2022?
Well, it decreased over a couple of years, and the drivers for return on capital employed for our business, when you do M&A, because of the fact you put goodwill on the balance sheet, typically that drives return on capital employed down. As you deliver organic growth post the integration of acquisitions, you see that return on capital employed metric move positively. So yeah, pleasingly, we are seeing return on capital employed post the acquisition of Custom Power turn back positive. So in years where you deliver organic growth, it's favourable for return on capital employed. In years where you do acquisitions, typically it's dilutive.
A couple of questions about recruitment and talent. How do you attract and recruit talent? And someone's added further here, we're told there's a shortage of UK engineering graduates and technicians. Is this true for you? Is it difficult to recruit staff?
So I think talent is partly, we're not centralised in any one area. We have different, we have operations in Redditch, in south of Birmingham, down towards Crewkerne in Somerset and Newcastle. That was something that's a good power area for us for engineering, and we're looking to expand that. We also acquire talent through acquisition. That's very important for us to do that and retain that talent. So there are various levers we pull on that. I agree it's not easy in certain circumstances, but we've got to, I think retention is also very important and looking after your staff. So it's not just additions, it's making sure there is a big churn, and we have a very loyal and stable workforce, 55 engineers in the group and 56 sales and business development people.
Do you do any apprenticeships or your own training schemes?
Through HR department, we do. We run those, and that's something we continue to roll out. Very important. Yeah.
And next question, which is kind of the flip side to a degree, I guess. How do you keep control on costs?
We run a very tight budgeting process that begins in January. We've obviously had to flex our payments last year. We're very conscious of inflation then, but we've managed that this year. There's a good split between basic salary and bonus for our staff. But it's important we maintain good levels of pay, especially at a production level. We've done that, ensuring we're well above living wage, but probably 70% of our cost is in people. But we work hard on maintaining that and keeping a very close eye on that through the budgeting process.
And we're a bit over time, but I've got a couple more quick ones to squeeze in if that's okay. How much revenue is recurring?
Pete, do you want to try and tackle that?
So, yeah, recurring revenue is always an interesting one. If you were to look at recurring revenue by customer, yeah, how much of our revenue comes from repeat customers? Very, very high. But actually, recurring revenue on individual products is a very different answer. So, yeah, if I gave you an example from the year I joined, we did a big program related to the QE class aircraft carriers. Well, that program, BAE built 2 of those, and we had a bunch of revenue with them as a customer. They are still a very important customer for us, but it's a different project. So for us, it's about being an extension of the customer's engineering expertise, having specialist expert knowledge where customers trust you and they come back to you for recurring projects and recurring programs. So is it recurring in terms of we're selling the same thing over and over again? No. Is it recurring in terms of customers? A very high proportion of what we do is recurring with customers. So BAE, Renishaw, the customers Gary talked about have been very long-standing customers. I've been with the group 7 years, and all of those customers have been customers for those 7 years, and I think Gary would say 20 plus in many cases.
I think another important facet is that the test equipment we build in, the capabilities we build into customers, so that they log that and they'll come back, and as we grow that capability, that's very important for them to see we can meet those challenges. There are there are not a lot of companies in the UK now that have that of a size that they can do that, and they can feel they can draw upon us to take that burden, especially in the defence sector.
And final one, how do you envisage funding the next acquisition?
It could be a combination. We're cash generative. We'll maximise bank debt where it's appropriate, but we are very supportive shareholders, and we'll go back to the market on that. Peter, I don't know whether you want to comment on sort of levels of appetite for debt.
Yeah, I think, yeah. Fortunately, we've got a very strong relationship with our banking partners, and they would lend us more than our shareholders would want us to take. Yeah, 1.5, maybe 2 times leverage at the top end for a short period of time is the sort of level of appetite we would have in terms of debt. But I think, yeah, as Gary said earlier, we're very conscious of dilution. We don't want to dilute unnecessarily. So we absolutely would look to use bank debt appropriately. That said, yeah, do we have supportive shareholders? Absolutely. And would we look to utilise them for the right opportunity where it's necessary? Absolutely, we would as well, as we did with Custom Power.
Okay, Peter, Gary, thank you very much indeed for joining us this evening. Thank you for the presentation.